What if I told you that a company growing at 750% per year just made a move that Wall Street almost never saw coming, going directly over the heads of a board of directors to speak straight to the shareholders they are trying to rescue? And what if the investors, sitting on a 96% loss, are still the last ones in the room to realize a lifeline is being extended? Welcome back to Smart Stock Sam, the channel where we break down the market moves that actually affect your portfolio, not just the ones that fill a news cycle. Today, we are going deep on Rezolve AI, ticker RZLV. We are breaking down exactly what happened on today's live investor call, what their bold merger play really means for your money, and whether this is genuinely the birth of a $700 million AI powerhouse or just another flashy headline that fades by Friday. Stick around, because by the end of this video, you will have a clear-eyed understanding of why this setup is one of the most asymmetric risk-reward scenarios in small-cap tech right now. Let's get into it. To understand why this merger is even on the table, you first have to understand who Rezolve actually is and why they are not the ones knocking with their hat in hand. Rezolve is playing what I would call an absolute leverage hand. And this distinction matters enormously when you are sizing up a position. On one side, you have a standalone business already on a rocket ship trajectory with $360 million in projected guidance for the year ahead. On the other side, you have this high-stakes catalyst, the proposed acquisition of Commerce.com. If that deal closes, we are looking at an instant $700 million revenue entity operating in one of the largest addressable markets in technology. But here is the kicker. Rezolve's leadership has essentially told the market that even if the deal gets blocked, the underlying value of their technology is so dominant that the outcome barely moves the needle on their long-term trajectory. That is a heads I win, tails I win more scenario that you almost never see at this stage of a company's growth. So what exactly is this dominant technology that justifies those kinds of projections? That brings us to the most important concept in this entire video. The buzzword of the year is AI. Everyone's got an AI story, but Rezolve is betting on something far more specific, something called Agentic Commerce. Think about the legacy AI we interact with today. You chat with a bot, it suggests a pair of shoes, and then you have to click the link, navigate the cart, enter your card details, and manually complete the checkout. It is clunky, it is slow. Agentic Commerce completely flips that script. In this new world, the AI agent is fully autonomous. It discovers the product, compares the prices across multiple platforms, and executes the entire transaction end-to-end without you ever touching a single buy now button. The shift is from digital assistant to digital executor. And if that sounds like something 5 years away, wait until you hear who is helping Rezolve build the brain behind it. Now, the biggest question for any autonomous AI handling real money is accuracy. If an AI agent is going to spend your dollars, it absolutely cannot afford to make things up. In the industry, we call that hallucination. When an AI starts generating plausible-sounding information that is simply not true, Rezolve's answer is their proprietary Brainpower engine. This is not a wrapper around a generic large language model. It is a purpose-built system tuned specifically for retail precision, and it was recently launched inside the Microsoft Foundry, putting Rezolve in an elite circle alongside names like OpenAI and Anthropic. By optimizing around 3 core performance metrics, sales closing rate, clarification quality, and product timing, they claim to have achieved near zero hallucination. In retail, that distinction is not just a feature. It is the difference between a completed sale and a customer service nightmare. But a brilliant brain is useless without the infrastructure to actually move money. And this is where Rezolve's real competitive edge becomes impossible to ignore. They have built what they call the Brain Suite, a 3-part system made up of Brain Commerce, Brain Checkout, and what I consider the real secret sauce of the entire platform, Rezolve Pay. Think about every online transaction you have ever made. Every time a merchant processes a card payment, they are silently handing 2 to 3.5% of that sale straight to legacy payment processors. Those are the invisible toll bridges of the old internet. Fees that have been quietly extracted from merchants for decades with virtually no innovation in return. Rezolve Pay is a frictionless payment rail built specifically to bypass those toll bridges entirely. By embedding the payment execution directly inside the AI agent layer, Rezolve is not just making the shopping experience faster and smoother, they are literally reclaiming margin that has been leaking out of retail for 30 years. This is a direct, deliberate attack on the traditional payment processing ecosystem, and it is a large part of why their revenue growth looks so radically different from anything else in this space. So what does that growth actually look like in numbers? Let us go to the 2025 data. In the last year, Rezolve processed 112.7 billion API calls. They reached 60 million consumer devices. They secured over 950 enterprise clients, and they finished the year with $46.8 million in revenue. Those are impressive numbers on their own, but the detail that should have your full attention is this: 543% growth from the first half of the year to the second half. That hockey stick curve is what venture capitalists spend years chasing, and it is happening right now inside a publicly traded company. But there is one hidden metric beneath these growth numbers that fundamentally changes the risk profile. And it is the single most important number in this entire analysis. That number is contracted revenue, and it tells us exactly how much of Rezolve's 2026 goal is already locked in. Most hypergrowth companies are burning cash and constantly diluting shareholders just to keep the lights on. Rezolve is in a fundamentally different position. They are sitting on over $750 million in total capital. They are fully funded. Management has stated they need zero additional equity to hit their 2026 targets. And of that $360 million guidance, $232 million is already contracted revenue. Nearly two-thirds of a 750% year-over-year growth target is already secured by signed contracts. For an investor trying to assess risk, that is enormous. You are not betting on whether they can find customers. You are betting on how quickly they can onboard the ones they already have. Now, with that kind of momentum building underneath them, Rezolve decided to take a massive swing at a struggling competitor, and this is where the drama really starts. On February 22nd, Rezolve privately proposed a one-for-one merger with Commerce.com. The board rejected it without even engaging. So on April 8th, Rezolve went public with a two-for-one offer, framing it as a last chance to halt the wealth destruction happening inside that company. How did the Commerce.com board respond? They did not schedule a meeting. They did not open a conversation. They hit the panic button on April 14th, adopting a defensive mechanism known as a stockholder rights plan. And that led directly to today, April 15th, where Rezolve bypassed the board entirely and took their case straight to the shareholders themselves. This is a textbook case of proactive shareholder value clashing head-on with a self-protective board. But why Commerce.com at all? What does a hypergrowth AI company want with a legacy player that is barely moving? The answer is distribution, and the math is devastatingly simple. You take the Rezolve AI stack and the Rezolve Pay rail, and you deploy it across Commerce.com's installed base of over 60,000 online stores. The result is not just a new company. It is an instant $700 million revenue leader operating in a $144 billion addressable market. By migrating those 60,000 stores onto Rezolve Pay alone, the combined entity would see immediate profitability. It is the ultimate synergy play. World-class AI infrastructure plugged directly into a massive, pre-existing distribution network. But the two companies could not be more different in how they are actually performing, and the contrast is stark. Rezolve is on a 750% growth trajectory with a Microsoft-backed technology foundation. Commerce.com is guiding for 1.5% growth. In this market environment, 1.5% is not growth. It is a white flag. Since its IPO, Commerce.com has seen 96% of its equity value destroyed. 96%. When Rezolve looks across the table, they do not see a competitor. They see a distressed asset that needs to be rescued before there is nothing left to rescue. So if shareholders are sitting on a 96% loss and someone is openly extending them a lifeline, why is the board working this hard to block it? That brings us to the poison pill. And once you understand how this mechanism actually works, the whole situation becomes even more frustrating to watch from the outside. For anyone unfamiliar with the term, a poison pill, officially packaged as a stockholder rights plan, is essentially the nuclear option of corporate self-defense. The mechanism works like this. If a so-called hostile bidder like Rezolve acquires more than 10% of the outstanding stock, the board immediately triggers a clause that allows every other insider to purchase new shares at a steep, artificially subsidized discount. That rapid influx of discounted shares violently dilutes the bidder's stake, making a full acquisition almost prohibitively expensive to complete. On paper, it sounds like shareholder protection. In practice, you have to ask yourself, who exactly does this mechanism protect when the stock is already down 96%? Because it is clearly not the shareholders watching their investment approach zero. It is the board protecting their seats. And that tension between board entrenchment and genuine shareholder interest is precisely what makes the current setup so compelling for outside observers. Here is the actual arbitrage sitting on the table right now. Commerce.com is currently trading around $2.50. Rezolve is offering a 2-for-1 exchange ratio. Wall Street analysts currently have a consensus price target of $11 for RZLV. Do the math. Each Commerce.com share, if exchanged for Rezolve stock under this deal, carries an implied value of $5.50. That is more than a 100% premium over the current market price, derived purely from the exchange ratio itself before any additional upside from Rezolve's underlying growth trajectory. But the valuation premium is honestly only half of what makes this compelling. The other half is something most retail investors completely overlook, and that is liquidity. One of the most underappreciated and genuinely dangerous risks in small-cap investing is being trapped in a position you cannot exit. Commerce.com is currently what traders call a zombie stock. Dead volume, no real price discovery, and no clean exit. If you try to sell a meaningful position today, you are essentially crashing the price on yourself before you even get out. Rezolve, by contrast, trades over 23 million shares daily. That is a liquid, functioning market. By making the exchange, shareholders are not just capturing a valuation premium, they are escaping a stagnant pond where they have been treading water for years and gaining access to a high-speed highway where they can actually manage their position actively and take profits when they choose to. And all of this converges on one specific date that every stakeholder in this story needs to have circled on their calendar: May 14th, 2026. That is the Commerce.com board election, and it represents what may genuinely be the final opportunity for long-suffering shareholders to break the cycle of destruction that has defined this company since its IPO. Rezolve is essentially delivering a clear directive to the owners of this stock. Your vote is your voice, and your voice is the only tool left that the board cannot block with a poison pill. If new board members are elected, members willing to actually sit across the table and engage with Rezolve's offer in good faith, the merger can proceed, and the $5.50 implied arbitrage has a real path to becoming reality. If the current board survives the election and continues stonewalling, the zombie trajectory almost certainly continues grinding lower until there is nothing meaningful left to protect. Before we get to the final verdict, I want to be transparent with you, because this is Smart Stock Sam and we do not hide the fine print here. This video is for informational and educational purposes only. Nothing in this video constitutes financial advice, investment advice, or a recommendation to buy or sell any security. Always do your own research and consult with a licensed financial professional before making any investment decision. Markets involve risk, past performance does not guarantee future results, and small-cap stocks in particular carry elevated volatility. We have covered the bull case here, but every investment has two sides, and yours should too. Now, here is the bottom line. If the merger succeeds, RZLV shareholders own an instant $700 million AI powerhouse deployed across 60,000 stores with immediate profitability on the table. That is the bull case realized. But if the merger is blocked, Rezolve remains a fully funded, standalone technology business with 90% plus software margins and $232 million in already contracted revenue. The core engine does not need commerce.com to keep running. The acquisition is an accelerant, not a life raft. The real story here has always been the transition to Agentic Commerce, and Rezolve has already secured the front row seat for that shift, merger or no merger. So I will leave you with this question, and I genuinely want to hear your answer in the comments below. If you were a commerce.com shareholder sitting on a 96% loss, would you vote to accept this deal, or would you hold out hoping the current board somehow turns it around? Drop your answer below. I read every single comment. If you found this breakdown valuable, hit that like button. It helps this channel reach more investors who need to see this kind of analysis. And if you are not subscribed yet, what are you waiting for? We break down stories like this every single day on Smart Stock Sam. Hit subscribe, ring the bell, and I will see you in the next one.